Hey there, and welcome to Real Estate Unpacked. So here's a question. When someone asks you what's happening in the real estate market right now, do you have an answer? Like a real one? Not the vague, it's a great time to buy, or inventory is tight stuff. I mean the kind of answer that makes people lean in and go, wait, how do you know all this? That's what this podcast is about. Every week, we are going to unpack what's actually moving the real estate market. The trends, the data, the economic shifts that matter. It's the stuff worth knowing. Whether you're a real estate agent who wants to be the go-to advisor in your market, or you're just trying to figure out if now's the time to make a move, this show is your weekly briefing on what matters right now in real estate and why. So let's unpack it. So it's Monday morning, you're drinking your coffee, scrolling through the news, and you see it. Mortgage rates just dropped below 6% for the first time in nearly 3 years. And you think, wait, what? How did that happen? Well, buckle up because we've got quite the story today about presidential orders, mixed signals from the job market, and what all this actually means if you're thinking about buying or selling a home right now. So let's start with the announcement that moved the market. Last Friday, mortgage rates dropped below 6% for the first time since February 2023. That's nearly 3 years, folks. Some of you listening might have toddlers who never lived in a sub 6% rate environment. Wild, right? The average 30-year fixed rate mortgage rate hit 5.99%. And yeah, I'm aware that's still basically 6%, but in mortgage land, getting under that psychological barrier is like when your diet scale finally dips below a round number. It counts, and we'll take the win. This is the first time we've seen rates this low since February 2nd of 2023. For context, that was back when we all thought inflation was transitory and ChatGPT was just a weird new toy. Simpler times. But here's where it gets interesting. This didn't happen because of some slow, grinding macroeconomic trend. This happened because at approximately 4 p.m. on Thursday, when most people are thinking about what to have for dinner, President Trump hopped on Truth Social and announced he'd be directing Fannie Mae and Freddie Mac to buy $200 billion, with a B, in mortgage-backed securities. And a quick translation for anyone who doesn't speak bond market, mortgage-backed securities, or MBSs, are basically bundles of home loans that investors buy. When the government steps in and buys a lot of those bundles, it pushes their price up. And when the price goes up, the yield or the return investors would make on those bundles goes down. Lower yields are how lower mortgage rates show up in the real world. The market reaction was immediate. According to industry reports, there was a substantial spike in trading volume for mortgage bonds at a time when the market is usually winding down for the day. That kind of activity signals that traders took this announcement seriously. Bill Pulte, the director of the Federal Housing Finance Agency that oversees Fannie Mae and Freddie Mac, confirmed shortly after that this plan is moving forward. So this wasn't speculation. Now, I think I know what some of you might be thinking. You saw what happened to interest rates the day after the announcement was made. That $200 billion MBS shopping spree hasn't even started and rates are already being affected. Sure, they'll go down more once they're purchased, right? I actually don't think so. So you have to remember that the mortgage markets react in advance of what they think will happen. So if they think there will be forces at play that will drive rates down, they'll go ahead and factor those into the current rates. So while it is possible that rates could go down a little more as Fannie and Freddie start shopping, the markets have already anticipated this move. So if rates do go down, it likely won't be by much more. Now, let's talk about what these rate changes mean in practical terms. Well, according to a Redfin analysis that came out last week, if you're a home buyer with a $3,000 monthly budget, you can now afford a home priced at approximately $479,750 with today's 5.99% rate. A month ago, when rates were at 6.35%, that same budget would have gotten you a $466,000 home. That's about $14,000 in additional purchasing power in just 1 month. But the bigger story is the 6-month trend. Back in July, when rates were around 6.8%, that same $3,000 monthly budget would have limited you to a $449,500. So in half a year, purchasing power has increased by roughly $30,000 for a typical buyer. To look at it from a monthly payment perspective, The median U.S. home costs about $433,000. With today's 5.99% rate, your monthly payment would be approximately $2,537. 6 months ago, at 6.8%, that same home would have cost you $2,720 a month, or about $180 more. Now, Chen Zhao, who heads economics research at Redfin, made an important point in this report, and it was said that this may be close to the lowest rates fall in the near term. The Fed is not expected to cut rates, and the MBS purchase program has natural limits. So if you've been waiting for perfect conditions, this may be as close as we get for a while. This improved affordability matters for sellers too. More buyers are coming off the sidelines now that rates are below 6%. And keep in mind that perfect timing doesn't exist in real estate. There's always some trade-off, rates or prices or inventory. Right now, rates are at a 3-year low and purchasing power has meaningfully improved. For buyers who are ready and financially prepared, this represents a genuine opportunity. Moving on from mortgage rates, while they were making headlines, we also got the December jobs report, and it showed some concerning trends. The U.S. economy added just 50,000 jobs in December, and that was below the 70,000 jobs that economists expected, and well below the roughly 100,000 jobs monthly pace we saw at the beginning of 2025. So job creation is clearly slowing. The unemployment rate did drop from 4.6 to 4.4%, which does sound positive, but some of that decline was due to people leaving the labor force rather than finding jobs. And when you stop looking for work, you're no longer counted as unemployed, which can make the numbers look better than the underlying reality. What we're seeing is what economists call a low fire, low hire environment. Companies aren't laying off people in large numbers, but they're also not actively hiring. Job growth that is happening is heavily concentrated in healthcare, with most other sectors showing limited gains. Now, this matters for housing because job changes are one of the primary reasons people buy or sell homes. As a Zillow article pointed out last week, when job growth slows and fewer people are changing jobs, housing turnover tends to decrease. People are less likely to relocate, first-time buyers may delay their purchase, and potential sellers often decide to wait. The one positive note, wage growth is holding at 3.8% year over year, which is running ahead of inflation in most categories. And importantly, the typical monthly payment for a new home buyer is down about 5.2% from a year ago, while rent is up only 2.2%. So even with the labor market cooling, housing affordability is gradually improving. So what is the Federal Reserve likely to do at their January 28th meeting? According to the CME FedWatch tool, there's a 95% probability that they'll keep the federal funds rate exactly where it is, and only a 5% chance of a cut and 0% chance of a hike. The Fed's current position makes sense when you look at the data. The federal funds rate is at 3.75%, down from a peak of 5.5% a couple of years ago. That puts them in what's considered the neutral range, where monetary policy is neither stimulating nor restricting economic activity. And when you're in that neutral zone, there's not much incentive to move unless you see clear signs of trouble. And the labor market supports this stance. It's not strong enough to warrant tightening, but it's not weak enough to require an immediate stimulus. It's stable, if unspectacular. Inflation also plays a role here. We are still above the Fed's 2% target, and there has been some complexity in the data. After the government shutdown, the Bureau of Labor Statistics has acknowledged that their data collection methods may have understated inflation, and the data distortion will continue until April. And what this means for mortgage rates is straightforward. Don't expect help from the Fed in the near term. They're likely to hold rates steady in January and probably in March as well. That means mortgage rates will likely stay in the current 5.9% to 6.1% range, with any further improvement coming from the MBS purchase program rather than Fed policy changes. So let's talk about what all this means in practical terms if you're thinking about buying or selling. First, understand that this is likely close to the best rate environment we'll see for a while. With the Fed holding steady and the MBS purchase program having natural limits, don't count on rates dropping significantly further from here. Also, your purchasing power has genuinely improved by about $30,000 over the past 6 months if you have a typical budget. That's a meaningful difference that could open up different neighborhoods or home types that weren't previously accessible. Also, you currently have some negotiating leverage, and this is what you've been hearing for a while now. With more sellers than buyers in the market, you can negotiate on price, request repairs, or ask sellers to cover closing costs. And then finally, competition typically picks up in the spring. If you're financially ready and have found the right property, waiting until March or April means you're likely going to be competing with more buyers. Now, if you are selling, sub 6% rates are bringing buyers back into the market. People who are waiting on the sidelines are starting to look again, which does create more potential buyers for your home. That's great news, but don't get too excited just yet, because all of the fundamentals we've been talking about on how to win in this market still matter. That means pricing strategy matters and presentation matters. So don't start to get too relaxed on those now. The underlying message for both buyers and sellers, there's rarely a perfect moment in real estate. If the numbers work for your situation and you're ready to move forward, these rate conditions represent a reasonable opportunity. Now, I would be remiss if I didn't address the uncertainties and risks that are still present in this market. The implementation details of the MBS purchase program remain unclear. We don't know the exact timeline, whether purchases will happen quickly or be spread out over months. That uncertainty is likely to create some volatility in mortgage rates over the near term. If you're locking a rate, understanding that it may fluctuate day to day would be good to keep in mind. The labor market is showing signs of weakness. While we're not seeing mass layoffs, job creation is slowing, and that can make households more cautious about major financial commitments. If the labor market weakens further, it could reduce housing demand and turnover. And while affordability is improving, home prices remain elevated relative to local incomes in many markets, particularly in coastal areas. Even with better rates, homeownership is still financially challenging for many potential buyers, especially first-time buyers. Now, these are not reasons to panic, but they are factors to consider. Real estate transactions are significant financial commitments, and it is important to understand both the opportunities and the risks. That said, waiting for the perfect conditions means possibly waiting indefinitely. There's always some uncertainty in real estate markets. The question is whether your personal situation, your finances, your job stability, your housing needs makes this the right time for you to act. Okay, now it's time for my favorite part of the show, where I take an economic concept and figure out what it means for real estate. Today, we are talking about bubbles. I was listening to the podcast Planet Money recently, and they had this episode about how to spot whether we're in a bubble. And with everything happening in our market right now, these rate drops, the shift in buyer power, I thought this was the perfect time to ask, where do we stand on the bubble spectrum? And here's the problem with bubbles. They're famously hard to spot while you're in them. It's like that saying, you only know you're in a bubble after it pops. But economists have actually identified some telltale clues to look for. The first sign of a bubble is when prices become detached from the underlying fundamentals, things like incomes, rents, and replacement costs. You're not paying for what something is actually worth. You're paying because you think someone else will pay even more tomorrow. So where are we with real estate? Well, home prices are still historically high, but here's the thing, they haven't been skyrocketing. In fact, in November, home prices only ticked up 0.2%. And if we look at purchasing power, how much house your income can actually buy, well, it's been improving as rates have come down. We're not seeing the kind of rapid exponential growth that screams bubble. Instead, we're seeing prices that are high, yeah, but relatively stable. The second bubble indicator is excessive speculation. When people are buying not because they need or want the thing, but purely as an investment bet. Think about house flippers in 2006 or people buying multiple investment properties with no money down. Right now, we are not seeing that. In fact, it's the opposite. According to a CNBC survey, buyers are buying because of life circumstances, like having a baby, moving for a job, retiring, downsizing. These are fundamental housing needs, not speculative bets. And here's another data point. There are currently 37% more sellers than buyer in the market. In a speculative bubble, you would see the opposite. Everyone trying to get in before prices go even higher. And the third clue is easy credit. Bubbles often form when anyone can get a loan, regardless of their ability to pay it back. Remember 2006, those ninja loans? No income, no job, no problem. Well, today's credit environment is the complete opposite. Mortgage rates have been above 6% for 3 years straight. Lending standards are tight. And if you can get a mortgage right now, you probably actually qualify for it. And the fourth indicator is a widespread belief that prices will keep going up forever. When everyone from your dentist to your Uber driver is telling you to buy because prices never go down, well, that's a bubble mentality. But I'm not hearing that right now. If anything, I'm hearing caution. Buyers are negotiating. Sellers are cutting prices. Real estate agents are saying the market is rebalancing. Nobody's claiming this is a can't-lose opportunity. So are we in a bubble? Here's my assessment. No, we are not in a bubble. But we're also not in a normal, healthy market yet. What we're experiencing is the unwinding of some distortions that have built up over the past few years. We had the pandemic boom, then the rate shock when the Fed slammed on the brakes. And now we're in this weird lock-in effect where people with 3% mortgages aren't selling, keeping inventory artificially constrained. And here's where I want to tell you to pay attention. With rates now dropping below 6%, we're going to see the tide start to change. Not drastically, we're not going back to 2021, but we'll see a gradual change. More sellers will feel comfortable listing because they can afford to buy their next home. More buyers will enter the market because affordability has improved. Competition will pick up, but not to the frenzy levels of a bubble. What we're likely heading toward is a more balanced market, which honestly is what we should want. A market where buyers have some negotiating power, where sellers can still get fair prices, and where people are making decisions based on their housing needs, not speculation. The real estate market isn't a bubble waiting to pop. It's more like a pressure valve that's slowly releasing. And that's actually good news for everyone. So where does all of this leave us? Well, if you're a buyer, it might be your moment. Rates are right at 6%, which we haven't seen this low since early 2023. And here's another thing working in your favor. There are hundreds of thousands more home sellers than buyers in the market right now. That means less competition, more negotiating power. But don't wait around thinking rates are going to drop to 5 or 4%. That's probably not happening anytime soon. And as rates stay low, competition is going to heat up in the spring. So serious buyers might want to act now. And if you're a seller, falling rates are good news for you too. These sub 6% rates are bringing buyers off the sidelines, but new listings have been losing steam. So if you're thinking about selling, now might be a good time to list while you've got motivated buyers out there and before the spring rush brings more competition from other sellers. So here's the big picture. What I find fascinating about this moment is we are watching the housing market find its equilibrium in real time. After years of extremes, the pandemic boom, the rate shock, the affordability crisis, we're finally starting to see some signs of balance. Not dramatic, not a crash, not a bubble popping, just an adjustment. The kind of gradual, boring market shift that actually creates opportunities for people who are paying attention. And that's exactly what we're here for, to help you pay attention, understanding what's happening and make smart decisions based on fundamentals, not on fear or hype. So this week, when someone asks you what's happening in the real estate market, you've got a real answer. And that's what we're doing here every Monday, giving you the intel you need to be the real estate economist of choice in your market. If you found this episode useful, hit subscribe. That way, every week, you'll have this week's market briefing ready to go. I'm Jennifer Templeton, fellow realtor and broker associate with the Crestage Group at Keller Williams Rockwall. And if this episode was helpful to you and you're buying or selling in the DFW area, or maybe you're an out-of-market agent looking for a trusted local partner, our group would love to be your real estate resource of choice. Visit www.thecrestagegroup.com/unpacked for next steps. Thanks for listening, and I'll see you next week.